Imagine waking up tomorrow and finding out that a single military operation has instantly reshaped the flow of trillions of dollars across the globe. That's exactly what happened with the US raid in Venezuela, and most people don't even realize it yet. In the blink of an eye, billions in oil revenue, billions in corporate assets, and untold geopolitical leverage shifted from one nation to another, potentially creating what some analysts are calling the largest wealth transfer in modern history. This isn't science fiction or a Hollywood thriller. It's the real-world intersection of finance, geopolitics, and precious natural resources. Now, let's unpack how one raid on Venezuelan soil could ripple through global markets, shake currencies, and rewrite the rules of oil dominance forever. The story begins with Venezuela itself, a nation that sits on the world's largest proven oil reserves, estimated at over 300 billion barrels, dwarfing even Saudi Arabia in potential energy wealth. Yet for decades, political turmoil, mismanagement, and sanctions kept this treasure trove underexploited, leaving Venezuela's economy in near collapse and its citizens struggling with hyperinflation that at times exceeded 1,000,000% annually. Meanwhile, the United States, a nation historically dependent on foreign energy sources, had watched from afar as Venezuela's oil, much of it heavy crude, sat largely untapped. Then came the dramatic raid that changed everything. From a financial perspective, the immediate effect was a sudden reallocation of control over Venezuelan oil production. Estimates suggest that Venezuela exports roughly 1.2 to 1.5 million barrels per day, mostly to global markets, generating billions annually. By asserting military and operational control over key oil facilities and tankers, the U.S. effectively gained direct access to these revenue streams. For major energy companies like Chevron and ExxonMobil, the opportunity is staggering. Analysts project the potential to increase Venezuelan production by 30 to 50%, which could translate into tens of billions in additional annual revenue. To put that into perspective, that's more than the annual GDP of countries like Honduras or Paraguay, funneling directly into the coffers of US-based corporations. A dramatic shift in economic power that has few historical parallels. The story isn't just about oil revenue. It's also about financial instruments and global markets. When Venezuela's leadership was captured, control over the nation's foreign reserves, sovereign bonds, and energy contracts suddenly became a point of leverage. Venezuela's central bank holds billions in gold and foreign currency, much of it previously trapped in complex international arrangements due to sanctions. With U.S. oversight and the threat of asset seizures, these holdings now represent potential liquidity that could be redirected to stabilize oil operations, fund infrastructure projects, or flow beer into the U.S. financial system. Think of it as a domino effect. One geopolitical move triggers cascading changes across stock markets, currency valuations, and even commodity prices worldwide. Historically, wealth transfers of this scale are rare but not unprecedented. Consider the post-World War II era, where economic dominance shifted from war-torn Europe to the United States fueled by industrial capacity and control over critical resources, or the 1970s oil shocks, where control over energy literally reshaped the balance of power between the West and oil-exporting nations. What makes the Venezuelan case unique is the convergence of modern finance, military precision, and energy scarcity, all occurring simultaneously in a hyper-connected global economy. Unlike historical transfers, which unfolded over years or decades, this one happened almost overnight, with real-time market repercussions. On a practical level, everyday investors are already feeling the ripple effects. The price of Brent crude surged by over 8% within 48 hours of the raid, while the Venezuelan bolivar continued its freefall, reflecting both market panic and confidence in U.S. intervention. Precious metals, particularly gold and silver, also spiked as traders sought a hedge against instability and potential currency manipulation. This is classic flight to safety behavior, but in a context where the underlying asset, Venezuelan oil, is itself being physically controlled and monetized by foreign powers. Understanding this connection is crucial. When a single country's energy output is commandeered, it doesn't just impact local markets. It sends shockwaves through commodities, equities, and even sovereign debt instruments globally. Yet, beyond the numbers, there's a broader narrative playing out. Geopolitics meets economics. By securing direct access to Venezuelan oil, the U.S. gains not just revenue but strategic leverage. Countries dependent on energy imports may find themselves subject to new pricing dynamics, while rivals like China and Russia, long invested in Venezuelan oil and infrastructure, face a recalibration of influence. This is more than a market event. It's a shift in global power structures, one that could define the next decade of energy geopolitics. And it's happening at a pace and scale that most people simply don't comprehend, which is why it's being called, by some analysts, the biggest wealth transfer in modern history. Control over resources also enables financial engineering. With oil contracts, futures, and options now linked to a US-controlled Venezuelan output, energy traders can speculate with greater confidence, potentially amplifying returns on investment. Meanwhile, currency markets respond to the bolivar's continued collapse, creating arbitrage opportunities for hedge funds and multinational corporations. The interplay between physical commodities and financial instruments is a key piece of this puzzle. It's not just about extracting oil, about strategically leveraging it across multiple asset classes to generate massive wealth flows, and the human element cannot be ignored. Venezuelan citizens, long suffering under economic hardship, now face uncertainty. While some may benefit from stabilization of energy infrastructure and international investment, many remain trapped in a cycle of scarcity and inflation. This stark contrast underscores the asymmetric nature of wealth transfers. In many historical cases, the movement of wealth is concentrated among elites and foreign actors, while local populations experience disruption rather than direct gain. It's a sobering reminder that geopolitical wealth transfers are often double-edged, enriching some while destabilizing others. Finally, the story is also about timing and precision. Unlike protracted political or economic interventions, this raid was designed for immediate impact. The synchronization of military action, financial leverage, and corporate opportunity is almost unprecedented. It represents a blueprint for how modern powers can rapidly redirect wealth and resources, combining strategic planning with market mechanisms. Observers liken it to a high-stakes game of chess, every move calculated to maximize asset control, financial return, and geopolitical influence. The question now is not if the U.S. can monetize Venezuela's resources, but how far-reaching the consequences will be, and whether this event marks a turning point in the global economic order. And as the dust settles over Caracas and Wall Street alike, the world is left to wonder how much wealth has truly shifted, who will benefit the most, and how will this shape the next wave of global finance. These are questions that investors, policymakers, and ordinary citizens alike will grapple with in the coming months, as the implications of this single operation continue to unfold across every corner of the financial and geopolitical spectrum of global markets. The U.S. raid on Venezuela has triggered ripples that extend far beyond oil barrels and bank accounts. Every commodity trader, hedge fund manager, and sovereign wealth fund now watches Venezuela like a high-stakes scoreboard, understanding that control over one of the world's largest oil reserves isn't just a regional advantage. It's a lever that can shift the dynamics of energy prices, currency valuations, and investment flows worldwide. Let's break this down first. Consider the immediate oil supply implications. Venezuela's heavy crude, long considered difficult to refine, suddenly becomes highly strategic when paired with US refining capacity and advanced petrochemical technology. Analysts project that by bringing production under coordinated U.S. oversight, Venezuela could add 400,000 to 700,000 barrels per day to global supply within the next 12 months. This increment alone has the potential to lower crude volatility and stabilize prices in certain markets, yet simultaneously creates competitive pressures for other oil exporters, including Saudi Arabia, Russia, and even domestic shale producers. But the impact goes beyond barrels per day. Every transaction, from futures contracts to derivatives tied to Venezuelan crude, is now influenced by a new geopolitical reality: U.S. corporations effectively controlling production and exports. For institutional investors, this is a massive recalibration of risk and opportunity. Imagine the hundreds of billions in energy ETFs, mutual funds, and index portfolios that include crude-linked assets. Suddenly, their underlying valuation depends not only on market fundamentals but also on the U.S. government's strategic decisions. This is where the concept of a wealth transfer becomes tangible. Capital that would have otherwise flowed to Venezuela's state-owned enterprises, foreign partners, or independent producers is now redirected through channels that ultimately benefit U.S.-linked financial structures and corporations. Adding another layer of complexity, consider Venezuela's foreign reserves and sovereign bonds. Prior to the raid, international sanctions had frozen or restricted access to billions in U.S. dollars, euros, and gold held abroad. With Maduro detained and U.S. authorities asserting influence over financial transactions, these assets suddenly acquire new liquidity potential. Large-scale investors, from hedge funds to central banks, now see an opportunity to restructure debt, purchase distressed Venezuelan bonds, or engage in asset swaps that could generate outsized returns. It's a textbook case of financial engineering, where a geopolitical move directly translates into marketable assets and cash flows, essentially turning political influence into measurable wealth. To understand the broader impact, we need to examine currency markets. The Venezuelan bolivar, already hyperinflated for years, has plunged further amid the raid, prompting speculative activity and currency arbitrage. Traders are exploiting gaps between official and black market rates, creating a parallel economy of opportunity that benefits those with access to foreign exchange and commodity hedges. At the same time, the US dollar has strengthened globally as confidence in American-backed energy security rises, further concentrating wealth in dollar-denominated assets. The interplay here is subtle but crucial. Control over Venezuelan oil translates into influence over currencies, which in turn amplifies financial gains for certain actors while exacerbating economic instability for local populations. History provides context for why this is significant. During the 1973 oil embargo, Arab nations used supply control to influence Western economies, leading to widespread inflation and stock market turbulence. The difference today is precision and immediacy. Instead of a slow-moving embargo, the U.S. has enacted a direct, instantaneous transfer of asset control. The consequences are measurable in real time. Crude futures, SPIC, ED, gold and silver rallied, and risk premiums on emerging market debt shifted almost overnight. For investors accustomed to decades of gradual market change, this is an unprecedented acceleration, a wealth transfer in warp speed. Some analysts have described, but let's not forget the corporate dimension. Chevron, ExxonMobil, and other major U.S. oil companies are now positioned to capture a portion of Venezuela's output that previously would have flowed to competitors or remained untapped. In practical terms, a single additional 500,000 barrels per day of production, sold at $80 to $90 per barrel, represents roughly $15 billion annually in revenue. Multiply that across potential growth in infrastructure investment, refining upgrades, and derivative markets, and the financial implications quickly enter the tens of billions, if not hundreds. This is wealth that has effectively shifted from Venezuelan control to U.S.-linked entities, with all the legal and political caveats accounted for, a modern manifestation of resource-driven wealth transfer. Of course, not all shifts are straightforward. Geopolitics complicates market logic. China and Russia, both heavily invested in Venezuelan energy through loans, infrastructure projects, and joint ventures, face a recalibration of their positions. Some analysts warn that this could lead to retaliatory measures, from supply chain disruptions to strategic alliances elsewhere. Yet, even in these scenarios, the underlying pattern reinforces the narrative. Control over critical resources equates to the ability to redirect capital flows on a global scale. For ordinary investors or governments dependent on energy imports, the lesson is clear. Geopolitical leverage now translates almost instantaneously into financial outcomes. Energy isn't the only domain affected. Metals and commodities markets respond dynamically. Gold, often seen as a hedge against currency risk, jumped as traders anticipated a bolivar collapse and potential Venezuelan gold liquidation. Silver, likewise, saw increased volatility as investors considered both industrial demand and precious metal hedging. The connection is straightforward. When one country's wealth is suddenly accessible to foreign powers, it reshapes not only oil markets but also the broader ecosystem of commodities and investment instruments. This interconnection highlights the modern mechanism of wealth transfer, multi-layered, cross-asset, and globally impactful. And while all of this unfolds in markets and boardrooms, there's a social and economic dimension. Venezuela's citizens remain in a fragile position. Inflation continues, basic goods are scarce, and the majority of the population sees little direct benefit from increased foreign control over their country's natural resources. Here lies the paradox of modern wealth transfers. They can concentrate capital and economic power in a few hands, while leaving local populations vulnerable. Understanding this dynamic is crucial for anyone trying to grasp the full scope of the raid's implications, both ethically and financially. Finally, the event sets a precedent for future interventions. It demonstrates how modern superpowers can leverage military, financial, and corporate tools simultaneously to achieve strategic wealth objectives. Unlike historical resource grabs, which were often slow and geographically limited, this integrated approach acts across borders, markets, and currencies almost instantaneously. The lessons for investors, policymakers, and global leaders are profound. The rules of wealth accumulation, resource control, and market influence are evolving, and those who understand the mechanics of this Venezuelan episode stand to gain the greatest advantage. As the international community reacts, questions arise. How sustainable is this wealth transfer? How will global competitors respond? And, perhaps most importantly, how will ordinary citizens be affected as billions in oil revenue and financial assets are redirected across continents? These questions set the stage for the next phase of the story, as the full consequences of the raid, financial, social, and geopolitical, begin to unfold with increasing clarity and urgency. Urgency surrounding Venezuela's wealth and its global ramifications cannot be overstated. What began as a targeted raid has evolved into a complex web of financial maneuvers, corporate expansions, and strategic positioning, creating a scenario that many analysts describe as unprecedented in scope. To understand the full impact, we need to look at the long-term consequences for energy markets. By consolidating production and export control, the U.S. has positioned itself as a near-monopolistic power in Venezuelan oil output. Even a moderate increase of 500,000 barrels per day under U.S.-backed management could influence global supply-demand equilibrium, potentially stabilizing prices for consumers in some regions while simultaneously pressuring competing oil producers to adjust output. This reallocation of energy influence is a textbook example of how resource control translates directly into wealth shifts across borders. But the wealth transfer doesn't stop at oil. Consider Venezuela's sovereign assets, including foreign reserves, gold holdings, and internationally held bonds. With Maduro detained and U.S. oversight established, billions in previously frozen assets are suddenly accessible for use in debt restructuring, investment in infrastructure, and corporate profit generation. To put this in perspective, Venezuela's foreign reserves alone are estimated at over $15 to $20 billion, while outstanding bonds could involve hundreds of billions in claims and payments if restructured or repurchased. The financial magnitude rivals some of history's largest economic shifts, such as the post-World War II transfer of industrial and resource control from Europe to the United States. What is unique here is the combination of immediate liquidity, strategic corporate leverage, and geopolitical influence, all occurring in a compressed timeline that accelerates the transfer of wealth on a global scale. For U.S. corporations, the opportunities are staggering. Chevron, ExxonMobil, and Bor. Other energy giants can not only secure future oil flows but also leverage derivatives, futures, and investment vehicles tied to Venezuelan production. A single additional 500,000 barrels, sold at $85 per barrel, translates to roughly $15 billion annually, a figure easily magnified through infrastructure projects, strategic partnerships, and financial instruments. Multiply that over 5 years and across multiple corporate entities, and we're talking about tens of billions flowing into U.S.-linked financial systems, an economic windfall generated by a single geopolitical intervention. Yet, as wealth accumulates in these concentrated channels, the social and humanitarian dimension remains stark. Venezuelan citizens, already subjected to years of hyperinflation and scarcity, may see minimal immediate benefit. Essential services remain fragile, food security continues to be threatened, and inflationary pressures on the bolivar persist. This asymmetry is common in wealth transfers of historical magnitude. The benefits are often concentrated among strategic actors, governments, corporations, and investors, while the local population experiences disruption, uncertainty, or, in some cases, further deprivation. It's a stark reminder that economic power, while measurable in dollars and assets, does not always translate into equitable outcomes for those directly affected. Strategically, the U.S. raid also sends a clear signal to global powers. China and Russia, both heavily invested in Venezuelan infrastructure and oil, face a recalibration of influence. Russia's joint ventures and loans, once assumed to secure ongoing energy flows, may now be exposed to legal and financial risk. China's investments, similarly, are subject to new constraints as the U.S. asserts operational control. In essence, this event is a demonstration of modern economic warfare, where military action, corporate strategy, and financial engineering converge to redistribute wealth and power in real time. This is not an incremental shift, it's a strategic recalibration of global influence. From an investment perspective, the ramifications are multi-layered. Commodities markets are already reacting. Brent crude prices surged over 8% immediately following the raid, gold and silver rallied as hedges against currency instability, and emerging market debt risk premiums shifted sharply. These are not theoretical models, they are real-time market responses to a reallocation of both physical resources and financial assets. Investors who can navigate this landscape, understanding the interplay of oil flows, bond restructuring, currency movements, and commodity hedging, are positioned to capitalize on a transfer of wealth that few historical precedents match. Historically, wealth transfers on this scale have often coincided with major geopolitical shifts. The post-World War II era, the rise of OPEC in the 1970s, and even the collapse of the Soviet Union, all represent periods when control over critical resources or financial mechanisms translated into concentrated economic advantage. What makes the Venezuelan case exceptional is the speed, the integration of multiple domains, military, corporate, financial, and the transparency of global markets today. Unlike previous transfers, which unfolded over decades, this event compresses the reallocation of wealth into months, with consequences measurable in billions if not trillions of dollars. Looking forward, several key factors will determine the sustainability and reach of this transfer. First, production stability. Maintaining and expanding Venezuelan oil output requires significant investment, technical expertise, and political oversight. Second, geopolitical responses. China, Russia, and regional actors may deploy countermeasures from trade restrictions to strategic alliances, which could partially offset U.S. gains. Third, global market demand, fluctuations in oil consumption, technological adoption of alternative energy, and macroeconomic cycles will influence revenue streams and asset valuations. Even so, the foundational shift has already occurred. Control over Venezuelan wealth, both tangible and financial, has been largely redirected toward U.S.-linked channels, with broad implications for global markets. Finally, consider the lessons for ordinary investors and citizens. The Venezuelan raid demonstrates that wealth in the modern era is not solely tied to production or labor, but to strategic control and timing. Governments and corporations that can leverage resources, political authority, and financial instruments simultaneously can accelerate wealth accumulation at a scale historically reserved for empires and post-war economic powerhouses. It underscores the need for awareness. Understanding how geopolitical moves intersect with markets is no longer optional for serious investors. Even gold, silver, or oil holdings can suddenly acquire new significance as a single event redefines their scarcity, value, and accessibility. In sum, the U.S. operation in Venezuela represents more than a headline-grabbing raid. It is a case study in how modern wealth transfers occur, rapidly, strategically, and across multiple dimensions. By consolidating oil production, accessing sovereign reserves, influencing financial markets, and projecting geopolitical power, the United States and allied corporations have orchestrated a reallocation of wealth that rivals some of history's largest shifts. The consequences will reverberate through commodities, currencies, corporate profits, and national strategies for years to come, illustrating that in the interconnected 21st century economy, control over resources is, in effect, control over capital itself. In conclusion, the U.S. raid on Venezuela is far more than a political maneuver. It is a seismic event in the global economy, triggering a rapid and multifaceted transfer of wealth that touches oil markets, financial assets, corporate profits, and geopolitical influence simultaneously. By securing control over Venezuelan oil, accessing foreign reserves, and leveraging strategic investments, the United States has created an unprecedented realignment of economic power, one that will influence markets, currencies, and global alliances for years. While ordinary Venezuelans face continued hardship, governments, corporations, and investors connected to the shift stand to benefit enormously, highlighting the stark realities of modern wealth transfers, fast, strategic, and historically consequential. As global markets adjust and geopolitical actors respond, the lessons are clear. In today's interconnected world, control over critical resources is the ultimate catalyst for wealth, influence, and long-term strategic advantage.